Welcome to Asset TV. I'm Jillian Kemmerer. Self-directed IRAs are becoming increasingly prevalent as retirees look to diversify. Here to help us understand the opportunities and risks associated with these types of accounts are a panel of experts. So welcome to the Self-Directed IRA Masterclass. First of all, thank all of you for joining us. It's wonderful to have you here.
Thank you.
Thanks.
Of course. Karin, talk to me a little bit about how the landscape has changed here. Have you found that self-directed IRAs have become increasingly popular over the years?
They really have. I think it's called the best kept secret, right? You've been able to self-direct for over 40 years, and I think that self-directed IRAs really rose in popularity during the recession when it was really difficult for people to find capital. And banks aren't lending, so they're looking for capital. Where can they find it? Well, they can find it in what's now a $26 trillion pool of retirement assets. And so a lot of private lending occurred because of that, and that's where people found money for real estate transactions. So that's one of the trends, is just the popularity has grown because self-directed IRAs do provide access to capital.
Got it. And Karin, what are you seeing here? What are the types of people that are pursuing it, and how are they using it?
Really, anyone can self-direct an IRA. So we see the whole range of people using self-directed IRAs. I think that, again, going back to the recession, a lot of people lost the value in their retirement accounts at that time. So I think many people are going out saying, well, what else is there? What else can I invest in? And so in addition to the real estate, as Jack mentioned, which is probably 95% of what we do, there's also private stock. So people with self-directed IRAs invest in private companies, or they invest in precious metals. So what I see is people who are looking to build their retirement. Maybe they're, in that demographic where they're really serious now about retirement, serious about saving, and trying to find a way to accelerate their savings that beats the stock market.
Got it. And is any degree of financial literacy required to self-direct an IRA?
Well, none is required, but of course, the more due diligence, the more education, the more research you've done, typically, the better your result.
Okay. I suspect that this will be a short answer, but just briefly, and I know that you're not financial advisors, can you each tell me, generally speaking, what you see the majority of people putting their self-directed IRAs into?
Again, a lot of private stock. We see a lot of that. We see notes like trust deeds and secured and unsecured notes with various levels of risk. We see, again, precious metals and real estate in all of its different forms, whether it is like, again, a private placement, maybe someone's going to buy a commercial building and an IRA is a member of that LLC, that private placement, or maybe it's raw land and someone's going to buy the land today and sell it much later. Real estate in all of its different forms, people do put into their self-directed IRAs.
And Karin, have you seen the same? Is there any particular trend that you see in terms of whether or not a person that chooses to do this is seeking outside advice?
Not really. I mean, people will go either way. Either they're going to be independent and maybe they're attending meetup groups, or they're finding ways to research independently, or they are using a financial advisor who suggests maybe they need to diversify. So both ways.
Okay. Let's start to drill in a little bit into the actual structure of a self-directed IRA. So Karin, I'll stay with you for a moment. What investments can be held in one?
Well, what's really nice is that the IRS doesn't tell us what we can invest in, only what we can't do. So it's a short list. It's life insurance contracts and collectibles. Everything else can be in a self-directed IRA. The question is whether or not that asset is administratively feasible.
Okay, and some coins, I believe there's a distinguish between what you can and can't hold there.
That's correct. It has to do with the level of purity of the metal.
And Karin, do you find that there are any common misperceptions in this space in terms of what it can and cannot invest in, who you can do business with, that you have to constantly kind of clarify?
Oh, that's what we do all day. I think I speak for everyone when I say that. Yes, for example, we had a gentleman who wanted his IRA to invest in real estate, pretty simple. And so he gives us a purchase and sale agreement, and we review it. And so it's the custodian for the benefit of his IRA, that's the buyer. Then we look and we see that the broker of record is his father. So his father, as Jack explained, is a disallowed person, so the IRA can't do business with the father. But on top of that, the father wanted a commission for being the broker of record, so that would also be benefit to a disallowed person. So we just couldn't do that. So yes, it's very, very common for people to misunderstand.
What are the required minimum distributions when holding alternative or non-cash assets?
Right, when you're taking your RMDs, getting financial advice, getting from a competent advisor is really important, especially also when you inherit an IRA from someone who's deceased. The rules are not simple. And so if you do inherit an IRA from someone who's passed away, that's another situation where, again, a competent advisor will really help.
Is there any difference between inherited a self-directed IRA versus, let's say, a traditional or 401k?
The only difference would be the asset that the plan holds. The rules are the same.
Yeah.
One thing that I thought of when I first heard the term self-directed IRA was this idea that the investor was very active, but that's not necessarily the case, right? Many of them are not actively involved, but are instead just holding longer-term investments.
I think that if you're self-directing, you need to be prepared to be involved. I think when you have a financial advisor, even when financial advisors are working with you, it's still self-directed. So the responsibility for doing the due diligence rests on the account holder, and you have to be active about that. It is self-directed, and so you do have to be prepared to get involved yourself.
This actually brings me to another point. There's one phrase that I hear over and over again when talking about the space, and that is administrative feasibility. Karin, can you explain to me what that means?
Well, when you say something is administratively feasible or not, it's immediately confusing. But I think that phrase came about because we don't advise and say whether an asset is good or bad, or how you write it off on your taxes, or we don't give legal advice and so forth. So if we say to someone, this asset that you wish to invest in is not administratively feasible, it means we're making a business decision that this is an asset that we will not custody. That's what it means. And there can be various reasons for that, but that's what it means.
Now, just to drill down, even if you deem something administratively feasible, it doesn't make you liable if something goes wrong. Is that correct?
I think too, another thing we do when we take a look at an asset, maybe an asset sponsor brings us a client and they wish to invest. It's ABC asset sponsor. Well, if we've done business with them in the past, what we're going to do is a look back and see how has that asset sponsor performed in the past. And if we see that they haven't performed or paid as agreed, or that things are wonky there, what we're going to do is say it's not administratively feasible. We don't necessarily tell the account holder what we see. We just say this is an asset we don't wish to hold.
Let's talk through some of the prohibited transactions. I know we've touched on them, but let's really drill down into, let's say, what the most common situations are. So can you give us an example of one and maybe some litigation around it if there's a relevant case?
I have an example of somebody who came to me and they wanted to take their 401k from their previous employer and they wanted to roll it over into a self-directed IRA for the purposes of making a loan. So I said, well, great, who would you like to lend the money to? And he said, well, my sister-in-law. I said, okay, well, the sister-in-law isn't a loud person. She's out to the side on the family tree. That's okay. But I thought I really should dig a little deeper. And I said, well, tell me, when your sister-in-law gets this money, what's she going to do with it? And he says, oh, well, she's going to invest in my company. So the IRS has something called the indirect rule, where if you can't do it directly, you can't do it indirectly. And then he would receive personal benefit from his IRA, and so that makes it a prohibited transaction.
So hugely important point there. And also it kind of seems, at least the theme that it's echoing to me, is that you can't benefit from this IRA before you actually retire.
I think it's good to add too that you can't provide goods, services, or facilities to the plan. That's how it's written in Internal Revenue Code 4975, if you'd like to look up the rule book. That, for example, if it's your IRA, maybe your IRA is again buying real estate and you want to be the broker of record, even for free you're offering services to the plan. Maybe that may not be the best example, but you can't do that. Or if your IRA buys a house and you wish to do the remodel, you're going to go in there and do that. Well, you can't. It's called an overcontribution of sweat equity. And so you can't provide services to the plan, whether it's free or whether you're paid. It's still prohibited.
I was just going to ask, can you explain the classic case of the vacation home?
I think a good point to make too, to follow along with what you're saying, once you do retire and you wish to live in that house, you don't buy it from your IRA because that's a prohibited transaction. So what you would do is you go out and get an appraisal for the value of that property, and you'd withdraw the house at the market value and get 1099 for the value of the property at that time. Then you could own it personally.
What happens if the account loses money, Karin?
Well, we hate that, obviously, and it's retirement money, and so when someone loses money in a retirement account, they don't get to write it off. So they just lose money. But what happens, say, for example, someone invested in a private placement and the value goes to zero and now it's dissolved maybe. On the rare occasion we see that the asset sponsor is in jail or something like that. But things happen where assets go bad. And so if that's the case, we can't, again, just state the value. What we do is we need a valuation. We need a competent valuator to evaluate and give us a report proving that value. And then we'll write off the asset as zero and close the account.
Karin, if you are caught doing one of these prohibited transactions, what are the consequences?
Well, you no longer have an IRA. I mean, if the IRS deems that you've committed a prohibited transaction, your IRA just doesn't exist anymore, and now that the funds are taxable and you'll be 1099 for them. That's the short answer. I'm sure our lawyer can give us a longer answer.
Karin, I know that due diligence is something that you think about, especially as you're on the board of RITA. So can
Right.
you tell us a little bit more about some of the due diligence measures that are absolutely necessary for someone who's embarking on opening a self-directed IRA?
When you're opening a self-directed IRA, of course, you need to check out the custodian or the administrator, that's true, but you really need to check out your asset. And the simple answer to that is the due diligence would be to maybe go online and Google the person, maybe with the word fraud after, and see if you're about to invest and put your money with somebody, have they ever been incarcerated? And I say that, but I've seen it happen. So you want to make sure that you're investing with a reputable person. You want to take a look and pencil out the numbers. You're investing in this asset. What are the acquisition costs? Now, all expenses of the IRA have to be paid for by the IRA. So is there adequate cash in the IRA to take care of any expenses that that asset may have? That's another thing to take a look at before you jump. Look before you leap.
Okay. And Jack, what would you say is sort of the first thing that you would say to someone who's looking into pursuing this? What do they need to know?
I would add something too. It's one thing to do your due diligence on the front end on an asset, but we saw a case where people didn't do their due diligence on the back end on a piece of real estate, where they didn't make sure, actually it was a trustee, they didn't make sure it got recorded. And so their IRA didn't have title to the asset. So again, due diligence on the front end, yes, but due diligence on the back end is equally important.
And Karin, we're going to get to what differentiates each of your businesses in a moment, but it appears that the people who can actually service these, it's quite unique. So for example, a Charles Schwab doesn't do self-directed IRAs. Why is that?
Well, that's their choice in their business model, also because they're licensed by the SEC and they're not allowed to sell some of these alternative assets. If you have licenses, you're not also selling real estate, for example. So it has to do with that primarily.
Okay. Talk me through a little bit more about your company. What makes you different in the space and what really is your edge?
We're also a third-party administrator, and so the self-directed IRA, as I see it, is in three parts, or three stations really, and it's to open the account, and so we have staff who help you open the account and talk to you about the asset that you wish to invest in and discuss that whole transaction with you to see if we can weed out any hidden prohibited transactions that they may not be aware of. And the second step is funding the account, bringing the money in, so we have staff that work directly with the account holder to help them bring their money in, and then we have a staff that helps the transaction coordinators, and they help the account holders to facilitate their investments and get the money out into the deal. So I think what's great about uDirect IRA services is that we have the personal hands-on service through each of these steps, and you get to know the people that you're working with. It's not like you're calling a large call center. Then you get to have really personal service.
Okay, and Karin, have you encountered any particular fraudulent situations?
Well,
here?
sadly I have. One is that someone invested in an unsecured note and did not bother to see if the asset sponsor was registered with the SEC or if the asset was registered with the SEC, and neither were, because that asset sponsor happened to have recently been incarcerated for 2 years for stealing millions. And so again, if she had done her due diligence, Googled the name of the asset sponsor with the word fraud, she would have seen she was investing with somebody who had in fact been in jail. Like elder abuse. Sometimes a child will want their elderly parent to make a loan to them from their IRA. We do see some of that, and we can't, if it's legal, we can't, well, you can't make a loan from your IRA to a child, but we do see some elder abuse, and it's difficult to really, get on top of that.
The IRS recently rewrote Form 5498. Can you tell us a little bit about what that entailed?
Right, and prior to this, the IRS had no idea what kind of assets were in the IRA, simply the value. That's all they knew. It could be a stock market asset, it could be a house, it could be a private placement, but now they know.
So a better way to look under the hood, effectively.
Well
Clearly.
Agreed. Okay. I'm going to take a quick poll and then I'm going to dive into why we're taking it. Do you allow IRA-owned LLCs?
We do.
You do?
We do, very under certain circumstances.
Okay. And Beverly?
I would agree with Jack. We don't intentionally take them, but we do have some.
Okay. Let's drill down into why this is a sort of cagey or dicey area. And Karin, I'll start with you. Talk us through where the complications are with this.
Well, like in the movie Spider-Man, with great power comes great responsibility. And when you have your entire IRA at your disposal, well, I think we should talk about what it is. It's your IRA invests in a special purpose LLC that's drawn up by a third party, not by you. Your IRA buys 100% of the initial units of that LLC, and now you get check writing authority. The LLC has a checking account. Now you can invest your IRA dollars. But the problem is that it needs to be in line with the IRS's rules, with these prohibited transaction rules, that none of them are violated. And a lot of times the average person doesn't really fully understand prohibited transactions. They're not simple. And so abuse can occur, and that is the major pitfall.
That's great. So I want to give you each an opportunity as we're winding down our conversation to share with us one or two things that you think really needs to be taken away from this, whether you're an investor that's looking to open up a self-directed IRA or a financial advisor that may be working with investors who are coming to you increasingly and asking for this.
Besides what everyone else has said, I think the number one thing is to save for retirement. That's a takeaway. There's a silver tsunami going on. I'm sure you hear about that all the time. 10,000 people a day turning 65. It's incredible. And a lot of us aren't prepared for retirement monetarily. I know Social Security was invented way back when to try to help us be prepared for retirement, but we're not. The ERISA laws that were founded and created in '74 and went into effect in '75, more than 40 years ago, were designed to help us save for retirement. So let's use these tools that we have so that when we retire, there's not a huge gap between what we have and what we need to retire, so that we can retire in style. So the takeaway would be, regardless of how you save for retirement, just do it. Make a contribution today to your IRA, invest in something, and plan for your future.